News today of a new valuation for Living Social, the daily coupon company that's a runner-up in that business to Groupon. A new round of financing values Living Social about $3 billion. Is that too high? Joining us now, venture investor Jeff Clavier. He's founder and managing partner of SoftTech VC. He owns stakes in Groupon and Twitter, and he's an early-stage investor in other startups. So, Jeff, fill in the blank on the company. This question of are they really worth it comes up time and time again. Specifically to Living Social, are they worth $3 billion?
They are the number 2 players in a fast-growing market. They are making a lot of money, a lot of revenue, fast growth. Investors who put some money in them just figured out that $3 billion was actually a good deal, and so that's why I heard a lot of people trying to get in this deal. Yeah.
It was a good
Very
deal for them. Groupon, as you say, owns the market. You're an investor in Groupon. You're supportive of a public offering for them?
Sure. I think that the growth that they've seen in just 2 years, getting to that level of penetration and revenue, has just been unprecedented. And so if they can sustain the $25 billion IPO that you guys sort of reported, obviously I will be very happy.
And that $25 billion IPO, that number is something you're comfortable with?
That's rich, but at the end of the day, the market will decide whether they can support it or not. If you remember, Google, when they tried to go IPO the first time, the market said no, and then they lowered the valuation and said yes, and it's been very successful. We'll see what Groupon sort of faces when the market looks at their offering, their revenue, their growth, and says this is sustainable or not.
With these two companies, with Groupon and Living Social, is this a Coke versus Pepsi battle that's being set up, or is this just sort of the new hot thing of the moment?
I think it's the new hot thing of the moment. E-commerce is back with a vengeance. There is, every second day, we have a new business coming to us saying, I want to be the Groupon for a certain category, a certain type of business. And being conservative, we passed on a few of those, and they've turned into tens of billions of dollar revenue-making companies. And so I think that because of those new distribution platforms, because mobile, 300 million people on mobile, we have several hundred million people on social networks that all are a new distribution mechanism for these companies that allows them to acquire users much cheaper than 10 years ago. And so the difference between what's happening right now and the previous bubble is that there is real revenue coming up in those companies, billions of dollars. Either this year or next year, we have those numbers in reach, and that's why.
You said the previous bubble.
The previous bubble.
Does that mean we're in a bubble?
No, I think it's very frothy from a valuation standpoint, but I'm not calling a bubble at all.
Frothy, but not a bubble. Well, you invest early on via a syndicate of investors, right?
Yes.
Typically $250,000, $750,000
yes.
is your first investment in
yes.
a company. Chris Sacca of Lowercase Capital, very well-known investor, stakes in Twitter and the like, he said he's holding off on new investments because these valuations are so high. He wants to wait till they drift lower. Why aren't you having more pause here?
So Chris has decided to go do a few things on the later stage side of the house, and he's bought a few shares of Twitter on the secondary market. What we've been doing is look at the value of those companies. We've held back on a lot of what we've considered being way too high valuations for early stage companies, and so we invest in companies which have great founders, great products, a real market opportunity at the right valuation. And so the day some of our investments are disclosed, you will see that we keep on investing today between 4 and 6 million pre, which is pretty much what we've been doing for the past 3 years. Yes, valuations have gone higher. In some cases, it's justified. In most cases, it's not. In those cases, we just pass.
You just pass.
So we're just selective.
You have sold a number of these companies you've invested in off
17.
to eBay, you've sold to Disney, you've had some real success.
Yes.
What are you investing in now?
Very excited in mobile. So mobile as a platform is a new one in the sense that you can reach hundreds of millions of users without having carriers involved. Lots of opportunities in monetization, lots of opportunities in customer acquisition. We're building infrastructure, investing in infrastructure, a few applications, gaming.
This is all around the Apple ecosystem.
Apple and Android. Android growing, much faster with an ecosystem which isn't as rich, and so we're actually putting a lot of money behind Android. We're doing a lot in e-commerce, looking at a lot of opportunities, and we've been doing for 3 years a lot of investments in SaaS. So
in what?
SaaS, so cloud-based infrastructure and applications. Pick up a vertical which has entrenched players, old technology, old customer acquisition costs, throw in new technology and using virality and the new way of acquiring customers on social, and put that in that market, you can create a real disruption, and that's really exciting. Marketplaces, we spend a lot of time on. AdStruck is a company here in New York which is trying to build essentially a marketplace for billboard advertising, bringing offline and online together. Extremely exciting.
Okay, well, Jeff, we've got to leave it there.